Imagine one morning you wake up and someone offers you a chance to become a partner in a restaurant. Not a small roadside tea stall, but a restaurant that has become the talk of the city. Every day, there is a long queue outside. New branches are opening every few months. Customers are happy, newspapers are writing about it, and everyone around you is saying, "This is the future." Naturally, your first question would probably be, how much money is this restaurant making? The owner smiles and says, "Last year we sold food worth 100 crore rupees, and this year we've sold more than 200 crore. Most people would stop right there and say, "That's incredible. I'm investing tomorrow." But if you've ever watched successful investors, you'll notice something interesting. They almost never get excited by the first number they hear. Instead, they begin asking questions that seem almost boring. They ask, out of those 200 crore of sales, how much money did you actually keep? Did customers pay you on time? Or are they still promising to pay next month? How much money did you borrow from the bank to build all these new restaurants? If business slows down for a year, will you still survive? Is the owner putting his own money into the business? Or is he quietly reducing his stake while telling everyone else to buy? These questions separate gamblers from investors. Now replace that restaurant with Vari Renewables technologies. When you buy one share of the company, you are not buying a moving line on a stock chart. You are buying a tiny ownership stake in a real business that builds renewable energy projects. The stock market simply gives you a daily price for that ownership. The business itself continues, running whether the market is open or closed. The first thing people usually notice is revenue. Revenue sounds complicated, but it is actually one of the simplest concepts in business. Imagine your tea shop served 100 customers every day last year. This year, it serves 200. Your sales have doubled. That's revenue. It simply measures how much business came through your door. For Vari, revenue has grown from around 1600 crore rupees to more than 3300 crore. On paper, that looks spectacular. But here's the catch. A crowded restaurant doesn't automatically become a profitable restaurant. You can serve twice as many customers and still lose money if your costs rise even faster. So professional investors move to the next number, profit. Profit is what remains after paying employees, suppliers, electricity bills, rent, taxes, and every other expense. Think of your own salary. Your company might pay you 1 lakh rupees every month. But after taxes, loan EMIs, insurance premiums, and household expenses, the money left in your bank account is what truly belongs to you. Companies work exactly the same way. That final amount is called profit after tax, or PAT. In Vari's case, profits have also doubled, suggesting that the company isn't just getting bigger, it is becoming more valuable. But experienced investors still aren't satisfied. They ask an even smarter question. Did the company actually receive the money? Imagine running your restaurant and serving meals worth 10 lakh rupees. Every customer praises your food, promises to pay later, and walks away. On paper, your sales look fantastic. Your accountant may even record a profit. Yet your bank account is empty because nobody has paid you. This is where receivables come into the picture. Receivables are simply money customers owe the business. They belong to the company, but they haven't reached the bank yet. If receivables keep growing much faster than revenue, investors become cautious because profits without cash can eventually become a problem. Then comes another important question. How much debt does the company have? Imagine two restaurant owners who both earn 1 crore rupees every year. One built his business using his own savings. The other borrowed 10 crore from the bank. On the surface, both look equally successful. But if business slows down, the second owner still has bank loans to repay. Debt works like a fixed burden. Low debt gives management flexibility, while excessive debt can turn even a good business into a struggling one. Vari carries relatively low debt, which is one reason many investors feel comfortable about its financial strength. Now imagine giving two different people 100 rupees each to start a business. One person turns that 100 into 120. The other turns it into 180. Who would you trust with more capital? That's exactly what return on capital employed, or ROCE, measures. It tells us how efficiently management converts invested money into profits. High ROCE is like giving money to a chef who somehow creates a 5-star meal from ordinary ingredients. It tells you management knows how to use resources wisely instead of wasting them. Another related measure is return on equity, or ROE. If shareholders invest 100 rupees into the company, ROE tells us how much profit those 100 rupees generate every year. It's similar to asking whether your savings are lying idle or working hard for you. Businesses with consistently high ROE often create long-term wealth because they know how to compound shareholder money efficiently. Then comes valuation, and this is where many beginners make expensive mistakes. Suppose two mango sellers are standing next to each other. One sells mangoes for 20 rupees, the other for 40. Without tasting them, buying the cheaper mango seems obvious. But what if the expensive mango is sweeter, fresher, and twice the size? The cheapest option isn't always the best value. Stocks work the same way. A great business can deserve a higher price because its future earnings are expected to grow rapidly. This relationship between price and earnings is called the price-to-earnings ratio, or PE ratio. But even that isn't enough. Investors also compare price with growth using something called the PEG ratio. If a business is growing extraordinarily fast while still trading at a reasonable valuation, it often attracts long-term investors looking for quality rather than bargains. Then there is management. Imagine boarding an airplane just before takeoff and watching the pilot quietly leave through the emergency exit. Would you remain seated? Probably not. In companies, promoters are like the pilots. When founders continue holding a large percentage of shares and avoid pledging them for loans, it usually signals confidence in the future. Their wealth rises and falls alongside other shareholders, aligning their interests with yours. Professional investors also pay close attention to what other institutions are doing. Large mutual funds and foreign institutional investors don't invest based on social media tips. They spend months studying industries, speaking with suppliers, customers, competitors, and management before deploying capital. Their buying doesn't guarantee success, but it often indicates that serious research has already taken place behind the scenes. Even after hearing all these positives, disciplined investors deliberately search for reasons not to invest. They ask whether revenue growth is sustainable, whether government policies might change, whether competition could reduce margins, whether delayed customer payments could affect cash flow, and whether today's high expectations are already reflected in the stock price. This mindset is perhaps the biggest difference between professionals and amateurs. Most people collect reasons to buy. Great investors spend even more time collecting reasons not to buy. If a company still looks attractive after answering all the difficult questions, only then do they consider investing. And that is perhaps the biggest mental model you can carry with you throughout your investing journey. Never think of a stock as a ticker symbol flashing green and red on your mobile screen. Think of it as buying a tiny piece of a real business. Ask yourself the same questions you would ask if someone invited you to become their business partner. How many customers does the business have? Is it actually making money? Is cash reaching the bank? Is debt under control? Can management be trusted? Is the price fair? And finally, what could go wrong? Because the moment you stop thinking like a trader, chasing the next price movement, and start thinking like a business owner evaluating a long-term partnership, you stop speculating and start investing. That simple shift in mindset is what separates people who merely buy stocks from those who build lasting wealth over decades.
Don't forget to like and subscribe.